Good morning, everybody. My name is George Khalife, host of Let's Grab Coffee. This is episode 8 with Mr. Jeff Dennis. Jeff is a lawyer and serial entrepreneur. He's the counsel and entrepreneur in residence at Fasken Martineau, one of the largest Canadian law firms. He's also the co-founder of the Toronto chapter of Young Entrepreneurs, which is now called Entrepreneurs Organization. He's created Lessons from the Edge seminars, where he brings entrepreneurs to share some of the big mistakes they've done and the lessons they've learned from them. And actually, this is what inspired Jeff to write his book, Lessons from the Edge. He is a sought-after public speaker. He's spoken around the world in countries like Thailand, India, Malaysia, Nepal, US, and Canada. Jeff, thanks so much for doing this.
It's my pleasure. I'm glad to be here. Good morning.
So, I'm assuming my audience right now, when they're hearing entrepreneur residence, might not understand the term. So can you just add a little clarity to that?
Well, yeah. So I'm a lawyer by education, but after practicing law very briefly at the beginning of my career, I started a business with some colleagues and ran a business for over 25 years. And so I'm really more entrepreneur than lawyer. But when I sold my business, and of course you mentioned the book and all of that, I kind of was trying to reinvent myself and decide, what do I want to be when I grow up? And I decided essentially to be a bit of a professional mentor, working with early stage emerging tech companies, helping them with commercialization and finance, but then also a bit of an angel investor. And I did that on my own for a while, but after I realized that I just didn't love working from a home office and I missed being around lots of people, I basically had been looking for a place to hang out that would be sort of a synergistic environment. And I bumped into a buddy of mine at Fasken Martineau, and he was tasked with the question, how does big law, old traditional law firm, do business with small tech, recognizing that, these companies have significant legal requirements because of protection of intellectual property and all sorts of other reasons. And yet they don't have a lot of money. And these law firms are expensive and these companies have no money and they're just not able to figure out how to do business together. And my friend was sort of struggling with that question, and here am I sort of looking for a place to hang out. And with the background that I had, we sort of put our heads together. And so my role is really now twofold. I'm this business advisor, so focusing on what's the product, who's the customer, what's the margin, what's the team that's going to be involved in executing this, who's the competition, how much money is it going to take to get to market, who's that investor likely to be, and how much, what's the deal look like. So that's kind of one piece. And the second piece is I see myself as an intrapreneur, building a small business inside this big organization, offering legal services to these emerging tech companies on a completely different business model. And so that's kind of what I do. I work exclusively with early stage, mostly tech, but just fast growth companies. And I guess, trying to help them get to that next level, make sure that their ducks are all in a row from a legal perspective, because when that investor comes in or when the buyer comes in, they're going to do due diligence, and you want to make sure that everything's tickety-boo.
Awesome. And Jeff, obviously most of your work is with, as you said, startups, but mostly with entrepreneurs. Is this a good time in Canada to start your own business?
Yeah. I mean, it could be better. I'm not saying it's ideal, but it is better than it has ever been. I think that there's, particularly in cities like Montreal, Toronto, of course, or the Toronto-Waterloo corridor, Vancouver, to a lesser extent in Ottawa, but we do see it. There are these hubs that have been created principally by government, but private sector have come on board. And, our universities are amongst the best in the world. Our hospitals are amongst the best in the world. Our doctors and professors and scientists and the technical people. So, Canada has, great talent. We have government support for this stuff. And there is more and more capital becoming available, although I would say that there's still a shortage of capital, and that's one of the major challenges that these companies have.
So would you say that that's the biggest impediment that Canadian startups have versus the US side in tech primarily?
Well, it's market, right? So, you know, Canadians tend to be parochial and, you know, focus on Canada. You know, we only have a 35 million population. So if you want to be a big company, you're going to have to look beyond Canada's borders. And historically, Canadians have been a little timid, except in a few sectors like mining, oil and gas, where we had, you know, true expertise. But, you know, I think the companies that have succeeded, the Canadian companies that have gotten big, have had to look at global markets, have had to look to the United States or China or India or Europe or whatever. And so that's really, you know, I think the limitation is this lack of ambition. You know, Canadians tend to be a little more cautious. And I guess that's good when it comes to our banks during the crash of 2008. But, you know, once the engines start roaring around the world, there are entrepreneurs from other countries that are just much more aggressive, think bigger. And so I think that's an impediment.
Interesting. And obviously we're talking about tech, right? And I think the biggest themes right now are around artificial intelligence, AI, machine learning, big data. Where do you see tech primarily have the biggest influence on other sectors like healthcare, financials?
Well, I think that every single company today is a tech company. You know, not long ago, there was the tech sector. You know, there was technology, there was computers, there was, you know, med tech, and you know, there was technology. But those were very specialized, and there were scientists and engineers and whatnot. But every business today is a technology business. Every business is either being disrupted by technology and is going to have to adapt, or its operational tools are being disrupted by technology, and jobs are being disrupted, and we see it everywhere. So I don't think there's a business that doesn't have to understand technology. And so those are the customers in some cases, but they're also the, you know, product developers and entrepreneurs.
What sort of disruption do you see happen most, say, within the next 5 to 10 years?
Well, I just think that I think the biggest challenge we're going to have is to match the talent requirement in terms of employees with the skill set that our labor force has. Right? Canada may be a highly educated labor force relative to some parts of the world, but our labor force does not have the tools en masse to do business in the 21st century economy. We need more engineers, we need more scientists, people coming, you know, through STEM. Because people without those skills are going to be disrupted by artificial intelligence, by robotics, and their jobs are going to go away. You know, when you hear Donald Trump talking about making America great again and bringing jobs back from China and India, like, that is never happening. Those jobs in China and India and Mexico and here and in the US are more likely to be taken away by technology, by artificial intelligence, by robots, by all sorts of technology that are job killers. And it does generate jobs, but they're high intelligence jobs. They're highly skilled jobs. The you know, commoditized jobs that involve rote, clerical work, all middlemen. I mean, disruption of middlemen. There'll be no middlemen. The world is getting rid of middlemen by using technology. Blockchain is a good example of how it destroys the middleman. But even just the internet, where e-commerce gets rid of retail, gets rid of, you know, all the middlemen. So that's where I see that we're entering into a period where there's a mismatch between skills and jobs, and that there's going to be a lot of people disrupted by this, and some people are hurt. And you're seeing the canary in the coal mine, the people that voted for Trump in the US, whose jobs are gone, they don't understand it, and they don't have the skills, and he's making promises that he can't keep.
On this topic, Jeff, I just want to stick to this point because I recently actually finished a book called Humans Are Underrated, and it's talking about exactly the subjects you were sort of mentioning. Now, we obviously discussed the challenges, right? So if you're not specialized in AI and machine learning and in that deep technology, then obviously, I mean, your labor is going to be disrupted. You're going to have to figure things out. What opportunities do you think that we as humans are going to really have to depend on? What qualities, traits in the next 10, 20 years that technology cannot replace fundamentally?
I'm no expert in this. Like, I'm just an observer who's trying to kind of figure it out for myself and my clients and my kids and, family. But I think creativity is probably the number one skill. The ability to think creatively, to work collaboratively, to have the understanding of basic science, mathematics, and technology. It never hurts to be a great salesperson. If you can generate revenue, you can always eat, right? Like the salesmen rarely starve. They'll just stay up late and work harder and, get their quota. They're the last people to get laid off because they're eat what you kill kind of characters. So, I mean, and leadership, but I think in this economy, the creativity, the ability to generate new ideas, to see the disruption that's coming and figure out those strategies to try and adapt. And what I'm seeing is change is happening exponentially faster. We look at what happened. I mean, the iPhone is not even 10 years old, or maybe it is 10 years, but it's not much more than that. And the world, like every decision we make is using one of these, and every purchase, and our lives have changed so much in the 10 years. I can only imagine what it's going to be like in the next 10 years.
It's funny we talk about, I want to go back to, because we're talking about challenges. The Lessons from the Edge, your book, plus the seminar that you were hosting and still do. What do you find startups are having the biggest difficulty with when actually starting this out and going on this journey? What are the biggest mistakes that they're actually doing?
Well, there's a bunch of things. First of all, a big mistake that I see is with respect to the ownership of their technology. So we have all these we talked about it earlier in the conversation about all these hubs and environments and ecosystems that have been, developed and built across Canada and elsewhere. And so what they're really designed to do is environments where you have collaborative creation, creativity. And so that's great. Product development, new marketing ideas, like all the juices are flowing, everybody's brainstorming, it's all great. The problem is that when you come out the other end, out of a incubator program, a startup weekend, coding in your buddy's basement and have a hackathon or whatever, who owns the intellectual property, right? And people don't think about it. And they promise percentage ownership to this guy and that guy. Well, you saw the movie Social Network, this Facebook story. Well, look at all the problems he had with partners and the guys, those two twins who, claimed that it was their idea. It's because of that collaboration, those conversations, it muddies the water over ownership of intellectual property. And under the law, just if you do nothing, the author generally is the owner. So whoever actually sat and coded or did the logo or created whatever they created, that person owns it unless there's some sort of agreement that it's either owned by somebody else or in a company, that whatever. But most people don't think about this. They're very focused on the product and as they should be. But they come out the other end and it could be a real problem, because if you're not all still friends or you don't all agree on how this thing's going to go forward, you got to get everybody to sign off. And if you have an outlier, then your whole thing can fall apart. Or you may have unintended partners that you didn't expect because you didn't sort of think it through. So that's a big challenge that we see. And no investor, no VC, no angel investor, or no purchaser down the road is going to buy a company that doesn't own its intellectual property if it's a tech company. Like, it just stands to reason. So that's a big problem. The second challenge I find is, people not knowing how to scale. I mean, I guess before that, the next big problem is finding that first customer, right? It's getting traction, finding the customer, figuring out the price, trying to figure out just where you fit in this market and actually showing some traction. That's tough. Once you have traction, then the next challenge is scaling it. And there doesn't seem to be as much experience in Canada in terms of scaling companies as we see in other places like Silicon Valley. And that may be one of the reasons you see Canadian companies moving to the Valley. Also because the third problem, or the fourth, I can't remember where we are, is just limits in capital availability. There's quite a bit of money at the early stage, government grants, SHRED, all sorts of programs, friends and family. You can usually raise somewhere between $200,000 and $500,000 between government and friends and family if you've got a decent idea and you're a mature sort of entrepreneur. It's going beyond that level and getting professional investment where you need some traction. It's really unusual for Canadian VCs to invest in a startup that doesn't already have some traction, have customers, have users. They know that they're investing in scaling up. They're not investing in getting off the ground.
And talking about capital, Jeff. Okay, so let's play out a scenario. I have a startup. I'm looking to raise capital. I'll maybe go to angel or a VC after my seed round, maybe a private equity. What are the biggest mistakes startups are doing to actually reach out to those VCs and get their attention, even if the product is worthy of their time?
Well, you just have to have basic things, right? Like you got to think about what's a VC's business here. Their business is to put money out and get it back within 5 to 8 years, or maybe 5 to 10 years in some cases, with some kind of like big return. That's it. That's all they're interested in. So they're going to look at all the risks and they'll do their legal due diligence. And if you don't own your IP, then we're not interested. If you got all sorts of weird, share structure and cap table with, you crowd funded your deal and you got 300 investors, they'll take a pass because they don't want to be partners with lots of yahoos. There's lots of things that they kind of look for. And what you need to do is in your presentation is make sure you have all those things in place. So, what's the product? What's the big problem that you're trying to solve? What is this problem? And how big is the problem? What's the market? And then, what's your solution to that problem? And is it sort of a incrementally better solution, or is it, nice to have solution, or is it a must have solution that's going to, disrupt this and make it so much better for the user consumer? And then who's the competition? Who else is out there, and how do you, what's your barrier to entry? How do you protect yourself from all the competition jumping in, and even if they're not sort of direct competition, but the people you're disrupting, how quickly can they pivot to try and, are they going to buy you? Are they going to start your, son of you, right? So they're going to look at all of that. They're going to look at the team, what their track record is, who they are, what they've done. They're going to look at the financial projections, and they're going to look at the assumptions. Like, do they make sense? If your first year revenue is $40 million and you have to sell to 1 million people at, $40 an item, where are you going to get the million people? What's your marketing strategy? What's the cost? What's the return? What's the lifetime value of a customer? What's the cost of acquisition of the customer? And all of that stuff has to make some sense, because if it's pie in the sky, then people will realize you don't know what the heck you're doing and they won't back you. And they're also looking for sort of the big upside because they invest in a portfolio approach and it's high risk sector, relatively speaking. So they're shooting for the moon. They're expecting some of them to fail. So the ones that succeed have to have a big enough potential upside to offset the risk of, some of them failing. So, the expectation in terms of return and upside will be significant. And there will be, some kind of time horizon, because these funds have a life. They're a limited partnership and they have a life. And at the end of that life, they got to give back the money to the investors. So you don't want to be taking money from a fund that's really close to its redemption period, right? You want to be at the front end of the fund, because at the back end of the fund, they may put pressure on you to sell or refinance or do something when it's not that convenient for you. So there's lots of things to think about. That's why they need a guy like me to guide them through this horrible, scary process.
There you go. You're scaring me now.
Ooh, scary.
Well, we were talking about exits, Jeff, and I just wanted to sort of mention this during our podcast. But what sort of exits are most common? I mean, I know we're talking about pressure, right? And if a VC is pressuring you, you might exit by a sellout, or you might be acquired, or you merge. What sort of transitions or patterns are you seeing?
The least common exit is an IPO. We're not seeing a lot of activity in Canada or the US for that matter. I mean, there are, but I mean, the companies that go public are the household names, Google, Facebook, but you're not seeing, early stage, fast growing tech companies going public that often. It's rare. So the exits, I guess, a lot of them, particularly in Canada, are what I would call acqui-hire situations, where they're acquiring the company, to acquire whatever the cool technology is, but the team of engineers that built it, and they'll absorb them into, the acquiring company, and they'll have bought that product. I see things all the time that, people are trying to bolt on to existing success products, products to, for Uber drivers, or products for, that tag along onto Amazon. And, well, if those basic businesses change their model, you're kind of out of business. Or they could just, build what you're building, or maybe they'll just buy you and you can be part of their offering because you've, improved their product. So I see some of that sort of strategic acquisitions. There are big fish, big companies that are are public, that are looking just to buy earnings and buy. So when a company becomes a certain size, they could be acquired by, a software acquisition company. Achievers was bought by a company like that called, it was called Blackhawk. So, those are the usual scenarios. Private equity sometimes. There's lots of ways. I see a lot of it going to the States, like the activities cross-border. And I also think we're going to see a lot more companies coming to Canada for access to the U.S. market because of this immigration business with the new Trump administration. A lot of the tech community it comes from Asia. Right. And I'm not saying they're all Muslim, but there are large portions. And if people who are newcomers to the United States don't feel comfortable, then these companies aren't going to be able to get the employees they need. And Canada is just a so much more tolerant environment. So I think we're going to see an uptick in activity coming this way in the next short term. Anyhow, we'll see.
We're seeing a lot of companies as well raise capital through crowdfunding, right? And I remember when I first met you through the event at Ryerson that you were speaking at, we sort of talked about this a little bit and asked you a question as a follow-up. What are the advantages and sort of disadvantage of not only crowdfunding but equity crowdsourcing?
Well, the biggest problem, first of all, crowdfunding seems to be best when we're dealing with things that can pull on your heartstrings. It's like an emotional kind of buy. So the ones that do well on the donation and pre-sale kind of crowdsourcing, they're all consumer things that hit at emotions and got great videos and go viral, and it causes people to make an impulse buy. I think it's very hard to crowd fund anything that's kind of an enterprise level, sophisticated type of product. unless there's a specific marketplace for, accredited investors like an angel list or something like that that sort of corrals them. But as a general rule, I think that if you want mass, it's going to be consumer, because plus the consumers kind of understand it. It's easier to understand because they might be the user for it. One of the negatives is that venture capitalists, if that's the way you're going down the road for a subsequent round of financing, just don't like being partners with 200 yahoos from wherever, and that are each in for $1,000 or $2,500. Having a complicated cap table just is not that appealing, and having all these partners, you could have class action lawsuits, you could have who knows, and they just don't want, it's just not worth the aggravation. So sometimes they'll have to clean it up. I'm working with a client right now where they crowdfunded. They have, I don't know, a couple, 300 investors, and it's very hard for them to convince the venture capital community that they should invest. And so we're looking at a private equity situation where the private equity investor might take out these investors, give them a return, and then put additional capital into the business to help for the growth capital. But it's not as clean, so it's tougher. Now, maybe over time, these types of financings will become more common. People become more used to it. People will come up with mechanisms to provide liquidity or some secondary market, because these things always evolve. I'm not the genius to know where it's going to be, but I'm sure they'll figure it out. I'm just not sure what it'll look like exactly.
I took an entrepreneurship class in university, and one of the biggest stats they usually float around or flaunt is that 9 out of 10 businesses usually fail upon starting up. I'm always curious. I mean, obviously, we all know certain reasons why, but with your tangible experience, why do you think that is? And I know you mentioned this before.
Well, I wrote a book. There's 50 reasons. And the thing I found is that when you talk to people and they tell their stories, they're not coming up with new reasons. They just picked one of the 50, or maybe they picked a couple of the 50, but people seem to make the same mistakes, right? Okay. They seem to make the same mistakes. Business isn't rocket science. There is a little bit of luck, but you got to have a customer. Like, the bottom line is you have to have a customer. You got to have a product that people will buy for a price that you can make money at. I mean, it's as fundamental as that. Beyond that, obviously, there's all these strategies. I mean, a lot of things fall apart because of partners. They get involved and they're in love with the business and they're really excited about the opportunity, but they don't really take a good hard look at who they're getting into partnership with, and whether they share the same values, the same timelines, work ethic, all that sort of stuff. Because everybody's all excited about the business and about the product, and whoa, we just got a new customer. But then when things get a little tough and time elapses, we find this guy's, a bit of a slacker, or this guy has reached his capacity that she or he's not smart enough to, fulfill the function now that the company's grown and our needs have grown. And so they end up in battles with partners, and, people just, it's like a marriage. It's really easy to get into, but it can be very messy to get out of it. And so it's like I said earlier about the intellectual property. It's often a good idea at the very beginning with your co-founders to sort of sort out what everybody's going to do, what our expectations are, what our timelines are, really hash it out, have a fight, don't go to bed hamad, figure out how you're going to resolve problems, because there will be problems, and then ultimately get yourself a shareholders agreement so that if there are problems, you can have some kind of tool to navigate your way out of it without the cost of going to court or having the business fail because you're focused on fighting and not selling.
I want to ask you just this question, because I usually hear it from my community, from my friends, that they'll have an idea, maybe it's an app, and they're so scared to share it with the world. And I remember when I was sitting in the front row of that Ryerson event, you said this exact thing: is actually share it, get people's advice. Obviously, be careful. be selective of who you talk to and receive feedback from, but you should actually receive this feedback so that it makes or improves the idea or product that you have. Can you just speak a bit about that?
Well, first of all, most people are lazy. And most people, like, how many people do you actually know, start businesses? I mean, more so today, but most people just don't, they're all talk and no action. And I just find if I just used to say to my kids, like, 90% is just showing up, right? So I just find most people don't show up. And so I just don't think it's a big risk. The question at my presentation came in the context of whether you should get a venture capital fund to sign an NDA. And what I said was that they wouldn't sign one because they see like tens of deals a day, hundreds of deals a week. And, who knows whether they've seen it before, might see it tomorrow. Like and they're not they're not in the business of stealing they got their own problems. They got all this money and they got to get it out and manage it and get a return on it. Like, they're not starting up a widget business. Like, that's just not, it's not their business. Somebody in competition with you, if you've got a newfangled telecom solution or, video streaming thing, like, I probably wouldn't run to Rogers right away just because, it's a threat to them and they might be interested in the, competitive intelligence. But most people, and the other side of the equation is you need to prove validation. Like, to get any money, to get any customers, you need to understand whether you've got a product that's anybody wants to buy. And then you have to understand, what would they pay? Like, what's the price for this? And then you have to understand, can I make it for that price and still have enough margin to make a living and run a business? And so, those kinds of questions, you're not going to answer them in the abstract. You got to hit the streets and talk to customers, talk to people. I mean, if you look at the lean startup sort of methodology by Eric Ries and David Blank or Stephen Blank, people like that, that's what they say. Create your MVP, your minimum viable product, a prototype, and go out and test it and find out whether people like it, what they'll pay, how they would use it, what features they like, what things they're not like. And based on that feedback, you're going to then make a decision on a pivot. Do you stay the course, or do you implement some of the feedback and change somewhat direction? And then you do it again and go into the market for feedback and understand whether you're on the right track now. And then you make a decision about pivoting again. Do you stay the course, or do we make a change? And so I just think you got to get out there and talk to people and try and sell it, because at the end of the day, that's everything. People so often believe in what I call the field of dreams school of startups. The field of dreams, the famous saying is, if we build it, they will come. Well, it isn't like that. If you build it, they might not know you exist, so then they don't come. Or you build it for the wrong price, or you build it doesn't work that way. So you got to build it and you got to test it, and then you got to build it again and test it and figure it out. And it's tough. I mean, I have a client who, he was very interesting. He had a brilliant idea. And for the life of me, I couldn't figure out what the revenue model was. Like, I could see how people would use what he was offering, but I just didn't understand how he was going to get paid. And he was disrupting Google. Okay, so he was taking on something that Google was doing, but they were like the primary player in that market. So, I'm looking at this thing and I say, well, you got two strikes against you. You got, a business model that nobody can foresee, at least I can't. And you're trying to take users away from Google. Well, good luck to you. But good luck to you. So, he wasn't sure, and, entrepreneurs are taught and it's in their DNA never to, take no. So I said, look, I'll introduce you to a whole bunch of people. You go talk to them. And, don't believe me, and there were people in the space, other potential mentors that were relevant to what they were trying to do. And he went out and he did it and he talked to them. and they gave him the same advice, it turned out. And he pivoted. He pivoted like so big, you wouldn't believe it, because it really had nothing to do with the old idea. But through these conversations and through the feedback, it inspired an idea. And that idea today does about 2 or 3 million in revenue. We just closed a $4 million financing. They got 50 or 60 employees, blah, 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 blah. And, you know, he pivoted and he got feedback and he like followed that lean process. And, you know, it works. Not always, but it works.
You know, I think splitting equity when you're first starting out is always a difficulty. So maybe if we put out a scenario, say there's 2 developers on the team, and 2 on the team that are in charge of business development, marketing, maybe investor relations. Say, how do you go about splitting equity? Do you do 100% and then taper down? Do you leave a little room for partnerships? Like, who gets more control usually? Is it the developer or the business side?
Well, it depends. I don't think there's any sort of hard and fast rules. You know, the problem is that what you need in your business today is not necessarily the same as what you might need for your business, you know, a year or 2 years from today. So you often overcompensate founders because you don't sort of anticipate that their contribution is going to maybe be less so down the line. And, you know, you never own as much of your business as you do day one or, you know, in the early days, because if this is successful, in most cases to scale it, they're going to bring in outside investors who are going to dilute everybody down. So, you know, I don't think there's a hard and fast rule, but I think you got to think about these kinds of things as part of the process. And you have to think about, you know, what that contribution, because most of these guys, it's sweat equity of some sort. And, you know, how are they going to be, compensated for that? And is 25% of the business overcompensation? You know, thing sells for $100 million, you got $25 million. So did he really contribute that much value? Or did he just win the lottery and rode your coattails? Right? And you're going to resent him for the rest of your life because you made this guy rich and all he did was like draw the logo or, you know, the first user interface that was such a piece of crap that it never saw the light of day, and we had to hire like another guy, and now this guy works for that guy, right? Like you see that, right? Where the job outgrows the people, and so you just got to be thinking about it and you got to be brutally honest about it. One technique that can be used is some sort of stock option arrangement where this stuff vests over a period of time based on either just staying for a period of time, you know, with 3-year vesting, a third, or it could be based on certain performance. You know, this guy is the sales and marketing guy. Okay, when you bring me the first $500,000 in revenue, you know, it vests. You bring me the next 500,000, the next third vests, or whatever. I mean, you can customize it, but that's one way of dealing with it. You know, if people put up cash, then cash is king. Because really what we're talking about now is sweat equity, right? Like you're talking about how to divide it up because we're all going to work. Well, I think you got to assume you're all going to get paid, right? Like, and then there's some risk. There's some risk that you're taking for taking a job with a startup instead of, you know, that developer going to work for, you know, Microsoft or whatever, because they'll, you know, his $100,000 salary, they'll pay him every 2 weeks direct deposit. Whereas the startup, you know, you're getting $100,000 of something, you know, so you want to get some upside for the risk that you're taking for not getting paid either anything or whatever. So, I mean, you got to think of it in those terms, not just, you know, it's my idea or, you know, because ideas are a dime a dozen. I get them every day, but they're worthless unless you execute.
Exactly. Last question I have for you, Jeff. So I just wanted to know what's next for you. Like, what's in store? Is it another book, seminars, maybe starting a business? What do you have in mind?
You know, I'm loving what I'm doing. Fasken Martineau, for me, it's been, I was on the front lines and, sort of the I guess, chief operating officer. I mean, we didn't have titles like that, but I was really the hands-on partner in our business, and often dealt with problems in some of the investments we had, and had to go in as an interim CEO or fire people or hire people or put it into bankruptcy and make those kinds of decisions. So it was I did it for a long time. It was a stressful business, and we had ups and downs like so many businesses. So at this stage in my life, when I had the exit and I wanted to stay involved in business, this was really a way that I could have my cake and eat it too. I'm living vicariously through these entrepreneurs. I get paid to do it. Yeah, I'm not going to, make millions doing it, but it's what I love to do. It's a way for me to stay involved in these companies at this stage in my career, to give back and share, at least my perspective. I see myself more as a sounding board. Like, I'm not saying I'm always right, but let's have a conversation and figure out whether I'm right or not. And so I can be, my job is really to challenge these guys, and I find it like every day it's another company, it's another opportunity, it's another group of people, and so I'm very stimulated by that and enjoy doing it. I mean, we just did a deal, 3-year commitment to 111, the growth accelerator program that just moved into a huge space and is going through a major expansion. So, getting involved in that community and helping companies there and elsewhere, of course, it can keep me busy for a long time to come. So, anything's possible. Fasken's has given me the opportunity to exercise my creative juices, in the sense that I'm able to help them figure out, what's the business model. So I really am, I said intrapreneur. Like, I run this little thing that I'm doing from a business perspective. It's a P&L. I've got a team of people. We've got a philosophy and a focus and a strategy, and we're trying to make it happen. And we think we're the go-to firm in Canada for this. I mean, there are other people. We were first in the market. We've been innovating all along, and everybody else is sort of emulating us and playing catch up on us, and which is forcing us to continue to innovate and to think about how to deliver our services and my insights to people and leverage that. And anyhow, so I find it to be a challenge, and it's fun. I do this because I love to do it.
I'm glad to know that you're following your passion and that you're in a happy place, Jeff. So thanks so much for doing this.
That's great, George. Good to see you. Thank you, and we'll see you soon.
All righty. Have a nice weekend. Take care.
Bye-bye.